AppLovin Corporation, a Palo Alto software company that built an AI advertising engine, Axon, that matches mobile app advertisers with publishers through real-time auctions at scale.
App is one of the most remarkable stock stories in recent memory. Shares have risen over 30 times in 3 years, driven by a single insight. AI prediction transforms ad performance.
The story begins in 2011 in Palo Alto. Adam Foroughi co-founded AppLovin to build mobile games and the ad network needed to make them profitable. The company was born from necessity.
In 2018, AppLovin acquired Max, the in-app bidding platform that became dominant for mobile publishers. 4 years later, Axon 2.0 launched, applying language model techniques to ad prediction.
In 2024, AppLovin sold its entire mobile gaming portfolio for $900 million, completing a pivot to a pure-play AI software platform. Revenue run rate today exceeds $7 billion.
AppLovin's revenue is 100% software platform. No hardware, no media inventory, no content production. Axon serves as the prediction layer across every product in the portfolio.
App Discovery drives advertiser spend by predicting which users will install and engage. Max manages publisher-side auction dynamics. Adjust provides attribution analytics, closing the measurement loop.
Gross margins reached 88.4% last fiscal year, one of the highest in software at this revenue scale. Every incremental dollar of Axon prediction efficiency drops nearly fully to margin.
Operating margin hit 77% on $5.8 billion in revenue, with only 876 employees. That works out to roughly $7 million in revenue per employee.
Meta Platforms and Alphabet control the largest advertising audiences on the planet: Facebook, Instagram, YouTube, and Google. Search create reach. AppLovin simply cannot match in social and search.
The Trade Desk operates in connected TV and open web programmatic, a different buyer profile focused on brand advertisers rather than performance-driven mobile app install campaigns.
AppLovin's moat is Axon Precision on mobile. Its training data from billions of auction outcomes creates a prediction advantage that is genuinely difficult to replicate without the same mobile native history.
AppLovin's network spans hundreds of thousands of mobile apps globally, connecting billions of daily user touchpoints to advertisers across North America, Europe, Asia-Pacific, and emerging markets.
North America and Europe are the dominant revenue regions. Asia-Pacific represents a growing install market. Connected TV and e-commerce are the two expansion bets that management flagged heading into 2026.
Adam Foroughi co-founded AppLovin in 2011 and has served as CEO since day one, guiding the company from mobile gaming operator to AI software platform through IPO and the Axon transformation.
Foroughi's tenure is defined by a single strategic bet: sell the gaming assets, invest everything in Axon, and prove the model works at scale. The last 3 years are the payoff on that bet.
AppLovin, a lean 800-person software company generating $6 billion in annual revenue at 88% gross margin, built on an AI advertising engine that reshaped the mobile ecosystem.
Q1 2026 beat on both revenue and EPS. Whether Axon can replicate mobile success in connected TV and e-commerce is the central question. We break down the guidance in the full earnings episode.
AppLovin just delivered one of the most dominant earnings prints of the quarter. Revenue of $1.842 billion, up 59% year over year. Adjusted EPS of $3.56 crushed the $2.84 estimate by 25%. Q2 guidance of approximately $2.39 billion. The AI advertising machine is accelerating. This is Charged Alpha. I'm Hudson.
And I'm Lana. AppLovin is an AI-powered mobile advertising platform. Its core product, App Discovery, uses the Axon AI engine to match mobile app advertisers with users most likely to convert. The platform includes Max, an in-app bidding tool that optimizes publisher ad revenue. AppLovin also owns a gaming apps portfolio. Market cap surged to approximately $170 billion following the earnings beat.
Adam Foroughi co-founded AppLovin in 2011 and has led it ever since. He built the company from a gaming studio into an advertising technology leader by pivoting to software and investing in AI-driven ad optimization. The Axon AI engine applies machine learning to predict which users will generate the highest lifetime value for mobile app advertisers, a model that has compounded performance dramatically over the past 2 years.
Q1 2026 revenue of $1.842 billion grew 59% from $1.159 billion a year earlier. Cost of revenue was $203.6 million, producing gross profit of $1.639 billion and a gross margin of 88.9%. That figure reflects the software platform's near-pure economics, with minimal variable cost attached to incremental revenue.
Operating expenses beyond cost of revenue totaled $199 million, research and development $94 million, sales and marketing $61 million, G&A $44 million. Operating income reached $1.44 billion on a 78% operating margin. That is an exceptional margin for any company, let alone one growing revenue at nearly 60% annually.
Net income was $1.206 billion, a net margin of 65%. GAAP EPS landed at $3.57. Adjusted EPS, stripping out stock-based compensation, hit $3.56, beating the $2.84 consensus by 25%. The beat was broad-based across revenue, margins, and EPS simultaneously, with no one-time items distorting the picture.
On the balance sheet, AppLovin held $2.76 billion in cash at quarter end. Total debt is $3.51 billion in term loans. Net debt is approximately $755 million, modest leverage for a company now generating $1.3 billion in quarterly operating cash flow. The balance sheet is deleveraging rapidly without management needing to prioritize debt paydown over buybacks.
Free cash flow was $1.29 billion in Q1. AppLovin generated roughly half its full-year 2025 free cash flow in a single quarter. Management deployed $982 million of that back into share repurchases, reflecting conviction the stock was undervalued before the post-earnings surge. Declining share count amplifies per-share earnings growth as the business scales.
Q2 guidance calls for revenue of approximately $2.39 billion, sequential growth of roughly $550 million from Q1. That implies a $10 billion annualized run rate, a level that would have seemed impossible 18 months ago. Back-to-back guidance beats across multiple quarters have earned management credibility and driven the sustained multiple expansion in the stock.
Street reaction was uniformly positive, with a single key debate beneath the surface. The consensus view. Q1 and the Q2 guide confirmed AppLovin's software platform has durably shifted into a new growth orbit. The harder question is whether e-commerce and web advertising expansion beyond mobile gaming will sustain this trajectory at scale. That expansion is in beta and not yet material to reported revenue.
Bulls point to what they call the Axon flywheel. More advertisers running campaigns generates more conversion data. More data improves targeting. Better targeting generates higher ROI. Higher ROI attracts more budget. That cycle has been compounding since Axon launched, and analysts believe the flywheel is still in early innings with limited signs of saturation, particularly given the nascent e-commerce channel expansion.
The critical number analysts focused on was the Q2 guide of approximately $2.39 billion against prior consensus of $2.05 billion. That 17% guidance beat forced broad estimate revisions across the street. Multiple banks raised price targets to the $500 to $600 range following the print, pushing the consensus target above current trading levels.
Skeptics raise legitimate questions about runway. The mobile gaming advertiser base is finite. Bears argue that at $2 billion per quarter in software revenue, AppLovin is approaching a meaningful fraction of its addressable gaming market, and that sequential growth must eventually decelerate. The e-commerce expansion must succeed to sustain the current trajectory beyond the gaming vertical.
Consensus stands at 25 buys, 8 holds, 2 sells, a strong buy rating with an average price target near $445. The stock traded above 500 post-earnings, already beyond consensus. That gap reflects momentum pricing rather than pure fundamental valuation, with the market rewarding consistent beat-and-raise execution.
The bull case centers on TAM expansion. Mobile gaming is roughly a $30 billion annual ad market. Global digital advertising exceeds $600 billion. If Axon AI can drive performance for e-commerce brands the same way it does for app developers, the addressable market expands by a factor of 20, separating a good business from a generational one.
Margin compounding is the second pillar. 89% gross margins are already near peak software economics, but operating margins expand as fixed costs scale against growing revenue. Each incremental dollar of software platform revenue drops to operating income at near gross margin rates, making revenue growth more powerful at AppLovin's scale than at typical software companies.
Capital return power is the third pillar. Nearly $5 billion in annualized operating cash flow lets AppLovin repurchase nearly $1 billion in stock quarterly while managing debt and funding operations. Declining share count against rising per-share earnings compounds EPS growth, even if revenue growth moderates from the current 59% pace.
The bear case begins with valuation. At $170 billion in market cap and 27 times forward revenue, AppLovin is priced for sustained perfection. Any stumble, a Q2 miss, an e-commerce delay, an Axon underperformance quarter, compresses the multiple sharply. High multiple momentum stocks are vulnerable to sentiment reversals that exceed any underlying fundamental deterioration.
Platform risk is real. Axon AI depends on mobile app signal data. Apple's ATT framework restricted cross-app tracking in 2021, and Google is pursuing similar Android changes. Incremental privacy enforcement, or new regulatory action targeting mobile ad data, could degrade Axon's conversion modeling and break the performance loop that drives advertiser spending.
The gaming apps portfolio creates drag and conflict. Owned titles generate lower margins and face declining engagement. AppLovin running ads for third-party developers while competing against them with its own apps creates an inherent tension. Third-party customers may question whether their budgets are fairly allocated against AppLovin's own titles.
E-commerce execution is the near-term test. Moving from gaming to e-commerce requires Axon to perform outside its proven vertical. E-commerce brands have established Meta and Google relationships with different measurement needs. Winning those budgets requires performance compelling enough to overcome years of optimization invested in rival platforms.
The Trade Desk is the closest public analog. Both are AI-powered ad platforms at premium multiples. The Trade Desk focuses on CTV and the open web, while AppLovin dominates mobile. Trade Desk trades at roughly 18 times revenue versus AppLovin at 27, a gap reflecting AppLovin's superior growth and dramatically higher operating margins.
Google and Meta are the functionally relevant competitive benchmarks. Google's Universal App Campaigns and Meta's Advantage Plus compete directly for the same mobile advertiser budgets. AppLovin has taken meaningful share from both in gaming, extraordinary for a company a fraction of their size. E-commerce expansion moves AppLovin onto their home turf, where incumbents have far larger installed customer bases.
Magnite represents the SSP side, publishers optimizing inventory yields rather than advertisers targeting users. Magnite trades near 3.5 times revenue versus AppLovin's 27. That gap reflects the economics difference between an exchange model and an AI-powered performance platform, generating near 90% gross margins.
On valuation, 27 times forward revenue is expensive by any measure. But AppLovin simultaneously delivers 89% gross margins, 78% operating margins, and 59% revenue growth. No directly comparable public company exists at this profile. The premium reflects genuine scarcity of a compounding AI platform at this scale.
Pre-earnings options positioning was notably bullish, put-call ratio near 0.65, with call accumulation reflecting investor conviction in a beat. Implied volatility was elevated near the 70th percentile, pricing roughly a 10% implied move. The actual 15% post-earnings surge exceeded that range, a positive surprise even against elevated pre-positioned expectations.
Post-earnings flow concentrated in the 500 to 550 strike calls. Investors betting Q2 becomes another beat and raise quarter. At elevated implied volatility, those calls are expensive, meaning buyers are making high-conviction directional bets. Concentrated institutional call accumulation following a guide raise quarter typically reflects informed positioning rather than retail momentum chasing.
Insider dynamics reflect founder alignment. Adam Foroughi holds significant equity with compensation tied primarily to long-term stock performance. No notable open market selling was reported near the earnings date. The company itself was the most aggressive buyer, $982 million in Q1 repurchases at prices that proved well below the post-earnings trading level of $500 plus.
Combined read, the signals all point the same direction. Institutional options positioned for upside. Management deployed nearly $1 billion in buybacks. Founder equity alignment is high. Post-earnings call flow reinforced the bull thesis. That convergence, smart money positioning, corporate conviction, and founder alignment is a relatively rare configuration that tends to carry informational weight about near-term execution expectations.
AppLovin's Q1 was exceptional, 59% revenue growth, 25% EPS beat, 78% operating margins, Q2 guidance well above consensus. The 15% post-earnings move reflects genuine fundamental repricing.
Bottom line, AppLovin has built one of the most profitable software platforms in public markets. Bull case is e-commerce expansion and Axon compounding. Bear case is valuation and platform risk. At $170 billion, optimism is fully priced and the fundamentals keep delivering.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street